Welcome to the deep dive. We are so thrilled to have you joining us today. Whenever we sit down to build one of these custom tailored explorations, we always try to put ourselves in your shoes.
Right, exactly.
And looking at the calendar today, being March 9, 2026, I have a pretty good guess as to what might be on your mind right this second.
It's the closing bell, isn't it?
Oh, absolutely. I know that feeling. You're probably sitting there wondering exactly what happened to the stock market today.
Yeah.
How did the S&P 500 finish? Are the analysts panicking, or are they celebrating what to expect tomorrow morning? Who are the massive single stock winners today? I mean, the financial news cycle creates this incredible urgency, this hunger for the minute-by-minute horse race.
Which is entirely understandable. The daily movements of the market are dramatic.
Mm.
But the fascinating thing about the massive stack of sources we've gathered for you today is that they don't actually care about today's closing bell.
No, they don't.
They are looking at something much, much deeper.
Right, and that is the mission for this deep dive. We want to cut through the noise of the daily ticker tape and the talking heads shouting on television. If you want to know how the stock market actually works in 2026, you can't just look at today's specific numbers.
You have to understand the underlying blueprint.
Exactly. What is really driving the prices you're seeing today? Is it just pure mathematics? Is it human emotion and mob mentality? Are central bank policies secretly pulling the strings, or have these new artificial intelligence systems completely taken over the steering wheel?
And untangling that web requires pulling from some incredibly heavy hitters. To give you a roadmap of where we're heading, we are analyzing Goldman Sachs' 2026 macro outlooks, and we have a highly detailed 2026 investment webinar summary from U.S. Bank.
We also have a comprehensive guide to market cycles from Fisher Investments, and it gets even more academic from there.
Oh, definitely.
We've got a deep dive paper from NYU Stern focusing entirely on equity risk premiums. We're looking at foundational texts covering the efficient market hypothesis and its rival behavioral finance.
Plus, we have a genuinely unique study from Loyola University that uses decision tree algorithms to track the impact of quantitative easing.
Right. And to cap it all off, we're dissecting a cutting-edge 2026 research paper hosted on ArcSIF about a hybrid AI-driven trading system.
So while we aren't going to give you a recap of the last hour of trading, what we are giving you is the foundational logic of the market. We are looking at the evolution of market mechanics.
And the overarching theme here is tracing a path from the very human, very emotional panics of the past.
By 2008.
Exactly, like 2008. All the way to the cold, calculated machine learning algorithms that are dominating the trading floors right now in 2026.
A huge shift.
Before we plunge into the deep end, I do want to make a quick note on tone. Some of the institutional research we're looking at today discusses recent fiscal policies.
Specifically, the recently passed One Big Beautiful Bill Act.
Right. And because legislation inherently has political origins, we want to be crystal clear with you. We are remaining strictly impartial. We aren't here to endorse or criticize any political viewpoints.
The market itself doesn't belong to a political party. A quantitative algorithm doesn't care about campaign speeches.
No, it doesn't.
It only cares about how policy alters corporate earnings, shifts interest rates, or affects market liquidity. And that is exactly the lens we'll be using to analyze those inputs.
Okay, let's unpack this. I want to start with the 2026 macroeconomic landscape because that sets the stage for everything else.
The foundation.
Looking at the Goldman Sachs and U.S. Bank projections, they are painting a surprisingly specific picture. Goldman is forecasting what they term sturdy global growth of 2.8% for 2026.
But the interesting part is the United States.
Yeah. The U.S. is actually expected to outperform that global average, coming in at 2.6% GDP growth, which beats the broader consensus forecast that had it pegged around 2.0%.
That outperformance gap is a crucial piece of the puzzle. When an institution like Goldman Sachs calls a 2.6% growth rate sturdy, what they mean is that it's strong enough to support corporate profits, but not so aggressive that it triggers runaway inflation.
Okay, that makes sense.
They cite reduced tariff drag, easier financial conditions, and specific tax cuts as the primary drivers keeping the U.S. engine running slightly hotter than the rest of the world.
And based on that sturdy growth, Goldman is projecting the S&P 500 to rally 12% over the course of the year. They are calling it a broadening bull market.
That word broadening is really important context.
How so?
Well, for a long time, the market was being dragged upward by just a handful of massive technology companies. If you didn't own those 5 or 6 tech giants, your portfolio was basically flat.
Right, the mega caps were doing all the heavy lifting.
Exactly. A broadening market implies that the rally is spreading out. The mid-cap companies, the industrials, the financials, they are starting to participate in the growth.
Goldman does acknowledge that the tech sector, what they jokingly refer to as tectonic, is still leading the charge, but the foundation of the rally is getting wider.
But hold on, if we want to understand why equities are suddenly broadening out and poised to jump 12%, we can't just look at GDP, what?
No, you have to look at the actual cost of money.
If we connect this to the bigger picture, we absolutely have to look at the U.S. bank data regarding interest rates. The Federal Reserve's actions are the gravity of the financial universe.
That is a great way to put it. Over the last couple of years, the Fed has been actively cutting rates. They executed a 1% cut in late 2024, followed by another 0.75% reduction spread across late 2025.
So as we sit here in early 2026, the Fed funds target rate is hovering in the 3.5% to 3.75% range.
And the 10-year Treasury, which is basically the benchmark for almost every consumer and corporate loan out there, is sitting around 4.0% to 4.25%.
Right.
So break this down for me. I think most people understand that high interest rates make buying a house more expensive. But mechanically, why does the stock market throw a party when interest rates fall from 5% down to 3.5%?
Let's look at it from the perspective of a multi-billion-dollar corporation. Most massive companies carry significant amounts of debt. They issue corporate bonds to build factories, fund research, or even buy back their own stock. When interest rates drift lower, these companies can often refinance their existing debt at much cheaper levels.
Just like refinancing a mortgage when rates drop.
Precisely like that, but on a scale of billions of dollars. If a company can reduce its interest expense by $50 million a year, that $50 million goes directly to their bottom line as profit.
Wow.
Lower borrowing costs essentially act as an immediate artificial boost to corporate earnings, even if they didn't sell a single extra product.
That is massive.
Furthermore, on the consumer side, everyday people feel relief on auto loans and credit cards. That keeps consumer spending resilient, which feeds right back into the revenues of those exact same corporations.
Which brings us back to that policy tailwind we mentioned earlier, the One Big Beautiful Bill Act. The U.S. bank source explicitly notes this.
Yes, it does.
From a purely market mechanics perspective, this legislation is injecting increased deductions and lower corporate tax rates into the system.
So if you are a major corporation right now, your borrowing costs are dropping thanks to the Fed, and your tax burden is dropping thanks to the new legislation.
It creates a highly resilient environment for corporate profit margins. But while a spreadsheet might tell you that a lower interest rate environment naturally benefits defensive dividend-paying stocks like utilities, the real world is currently throwing us a massive curveball.
Oh, definitely.
I found this part of the U.S. Bank report fascinating. Traditionally, utilities are the boring, safe stocks. Your grandparents buy them because people always need to keep the lights on, regardless of the economy.
Right, they're the ultimate defensive play.
And right now, utilities are indeed surging. But U.S. Bank points out it has very little to do with traditional interest rate dynamics.
It's a non-rate catalyst, and it's one of the biggest stories in the market right now. Artificial intelligence.
Wait, utilities are surging because of AI. How does a power company in the Midwest become an AI stock?
It all comes down to data centers. The burgeoning development of generative AI requires an almost unfathomable amount of computational power.
Right.
You have thousands of specialized processors running constantly, which generates massive amounts of heat, requiring industrial-scale cooling systems. All of that requires electricity.
A lot of electricity.
The U.S. Bank report highlights that this rapid, staggering surge in electricity demand from AI data centers has completely transformed the utility sector. They are no longer just defensive, slow-growth companies. They have essentially become a backdoor infrastructure play on the AI boom.
That is such a crucial lesson. You can't just memorize a textbook rule that says lower rates equal higher utility stocks and expect to understand the market.
You have to look at the real-world catalysts. You have to look at where the physical demand is coming from.
Which is exactly why projecting market trends is so difficult. Catalysts change. And that brings us to the Fisher Investments data on market cycles.
This is where the historical perspective really helps.
If we are currently in this broadening bull market fueled by AI infrastructure and falling rates, the natural question every investor asks is, how long can this last?
Right. When is the music going to stop?
Exactly. Fisher Investments provides some incredibly useful historical averages to frame this. Looking at data stretching all the way back to 1946, a typical bull market lasts nearly 5 years.
5 years is a long run.
And over that average 5-year span, it delivers a 149% return on the S&P 500.
Contrast that with the historical average of a bear market. Bear markets, on average, last only about 16 months and result in a 34% drop. The math there is heavily skewed in favor of optimism.
But human psychology doesn't care about historical averages when the market drops 3% on a random Tuesday, right? People panic. They see a scary headline and think the 5-year run is over.
And that's exactly what the Fisher data warns against.
Yep.
They make a very stark differentiation between a standard market correction and a true bear market.
What's the difference?
A correction is a sharp, sentiment-driven decline. It might be 10% or even 20%. It feels terrible when you look at your portfolio, but it is typically driven by short-term fear or temporary structural issues.
Okay, so a correction is bad, but it passes. What's a bear market then?
A true bear market is different. A true bear market is usually triggered by what Fisher calls the wallop.
The wallop. I love that term. What exactly qualifies as a wallop? Because a bad earnings report from a major tech company can send the market down 100 points, but that's not a wallop, is it?
Not at all. A wallop is a massive, unforeseen event that is structurally capable of knocking trillions of dollars off global GDP.
Yeah.
It's not a slightly hot inflation report. It's the catastrophic thing that nobody was predicting in their glossy year-ahead outlooks.
So, like the onset of a global pandemic in early 2020.
Yes.
Or the complete collapse of the subprime mortgage market in 2008.
Exactly. Fisher argues that if an event does not have the fundamental capacity to cause global GDP to contract for 2 or more consecutive quarters, it's likely not a wallop. It's just noise. And the market will eventually digest that noise and recover.
Let me push back on that a bit, though. That sounds incredibly rational in hindsight. But when you are living through it, how do you know if the scary headline you just read is a temporary correction or a global GDP-crushing wallop?
That is the hardest part of investing. Fisher's argument is that because true wallops are so rare, acting on every scary headline is mathematically a losing strategy.
Because you miss the rebound.
Exactly. If you sell out of your portfolio every time the market dips 5%, you might avoid a few larger drops, but you will almost certainly miss out on the bulk of that average 149% bull market return.
It's the danger of trying to time the market. You have to be right twice. You have to know exactly when to sell, and you have to know exactly when to buy back in. And almost nobody can do that consistently.
Which is the perfect transition into the central debate of modern finance. If it is so difficult for an individual or even an institution to accurately time the market cycles, is it actually possible to outsmart the market at all?
I am so glad we are getting into this. This is the theory of everything for finance. We turn to our source on the efficient market hypothesis, commonly referred to as the EMH.
And to set the scale here, as of late 2023 data, the global stock market was worth an unfathomable $111 trillion.
$111 trillion. It is the largest, most complex information processing system humanity has ever built.
The EMH essentially argues that because this $111 trillion market is scrutinized every single second by millions of highly educated professionals, supercomputers, and algorithms, the current price of any stock perfectly and instantly reflects all available information.
So the underlying premise of EMH is that you cannot consistently beat the market.
Why? Because any piece of new information, whether it's an unexpected earnings beat, a merger announcement, or a new product launch, is completely priced into the stock the millisecond that information becomes public.
So if a pharmaceutical company announces a successful trial for a new drug at 9:00 a.m., I can't log into my brokerage account at 9:05 a.m. and buy the stock hoping to get rich because the price is already adjusted to reflect that new reality.
Exactly. The EMH dictates that stock prices follow a random walk. That means future price changes are entirely independent of past price movements.
A stock doesn't care what it did yesterday.
Nope. Its next movement relies solely on unpredictable future news. And since you can't predict the future, you can't predict the market.
Okay, I hear the theory, but let's be real. That assumes humans are perfectly rational calculating machines, and we know for a fact we aren't. We are emotional, fearful, greedy creatures.
This raises an important question, and it's the exact critique leveled by behavioral finance, which we explore in the World Journal of Advanced Research and Review source.
Right.
If the market is perfectly efficient, always pricing assets correctly based solely on hard data, how on earth do we explain October 1987?
Black Monday.
Black Monday. The Dow Jones Industrial Average plummeted 22.6% in a single day, Think about what the EMH claims. Prices perfectly reflect reality.
Right.
Was there a single piece of economic news that day that justified wiping out nearly a quarter of the value of the American economy in 8 hours?
No.
Did a quarter of all factories burn down? Did a quarter of the workforce disappear? No.
Or look at the 2007 to 2009 Great Recession. The S&P 500 fell 57%. Now, obviously, the subprime mortgage crisis was real, but did the intrinsic value of every single company in America drop by 57%?
The EMH really struggles to explain those massive, violent, panicky swings.
Behavioral finance steps in to fill that explanatory gap. It points out that humans do not process complex information perfectly. We use heuristics.
Let's pause and define that, because that's a term that gets thrown around a lot in psychology. Explain heuristics like I'm a beginner.
A heuristic is just a mental shortcut. When you are faced with a complex decision and overwhelming data, your brain doesn't have the energy to compute every single variable. So it uses a rule of thumb. It looks for patterns. Sometimes these shortcuts are helpful, but in financial markets, they lead to deep, predictable psychological biases.
And the paper highlights several of these specific market anomalies that prove we aren't rational. My favorite is the winner-loser effect.
Yes, the winner-loser effect is a classic example of human overreaction. Investors tend to bid up the prices of past winners way too high.
Right.
If a stock goes up 20% this month, humans assume it will go up 20% next month, so they buy it, pushing the price far beyond its actual fundamental value.
Conversely, they punish past losers too severely. They sell in a panic, driving the price down below what the company's assets are actually worth. Eventually, reality sets in, and you see massive reversals.
It's pure momentum. The paper calls it the momentum effect. A stock is going up simply because it's going up. It's the ultimate fear of missing out.
The FOMO is real.
If your neighbor is suddenly buying a second boat because he invested in some random tech stock, you want in too. You don't read the company's balance sheet. You just buy it to join the herd. That is herd behavior, and it fundamentally breaks the idea of a perfectly efficient market.
This tension between rational efficiency and irrational behavior is best captured by a famous debate highlighted in our sources between two legendary economic minds, Robert Shiller and Burton Malkiel.
Yes, Shiller is the pioneer of behavioral finance, and Malkiel is the staunch defender of the EMH. Let's break down their argument, because it really helps clarify how you can look at the exact same data and see two entirely different worlds.
Robert Shiller looked at historical market data and found something fascinating. He looked at the price-to-earnings ratio, the PE ratio of the overall market. Simply put, how much are you paying for $1 of corporate earnings?
Okay.
Shiller discovered that when the market's PE ratio is historically very high, the long-term returns for investors over the next 20 years tend to be very poor.
Meaning, if you buy when the market is expensive, you aren't going to make much money in the long run.
Right. So Shiller argues this proves the market is sometimes irrationally exuberant. It forms bubbles. And because we can identify these bubbles by looking at high PE ratios, the market is not perfectly efficient, and investors should reduce their exposure when prices seem disconnected from underlying earnings.
But Burton Malkiel looks at the exact same data and says, hold on, you're missing a variable.
Malkiel pushes back hard. He argues that just because returns vary over 20-year periods doesn't mean the market is irrational or bubbling. He says you have to factor in interest rates during those specific historical periods.
I think we need a really concrete analogy here. Let's step away from stocks for a second. Let's talk about real estate. Imagine you are looking to buy a 3-bedroom house in a normal suburban neighborhood.
Okay, I'm with you.
Shiller looks at the housing market and says, look, the historical average price for this house is $300,000, but today it's selling for $600,000.
And local salaries haven't doubled.
Exactly. The price has decoupled from the fundamental income of the neighborhood. This is an irrational bubble driven by herd mentality, don't buy the house.
But Malkiel steps in and says, it's not an irrational bubble at all. 10 years ago, when the house was $300,000, mortgage rates were at 8%. Today, mortgage rates have dropped to 4%. Because borrowing the money is so much cheaper, a buyer can afford to pay a higher sticker price while maintaining the exact same monthly payment.
Exactly. Malkiel is arguing that the market is a perfectly calculating machine. It's pricing the house or the stock perfectly based on the current cost of debt. It's not a bubble, it's just math.
And that debate leads us to the absolute core of investing. If the market is this complex mixture of Malkiel's perfect math and Shiller's imperfect human emotion, how do we actually figure out what the risk is worth?
Why do we bother investing in these volatile emotional stocks at all when we could just park our cash in a completely safe guaranteed government bond?
That is the trillion-dollar question.
And to answer it, we turn to a comprehensive paper from NYU Stern, authored by Aswath Damodaran, focusing entirely on the concept of the equity risk premium, or the ERP.
The ERP is one of the most vital concepts in finance, yet it rarely gets discussed on the evening news. Let's define it really simply. When you buy a U.S. Treasury bond, you are essentially lending money to the U.S. government.
Assuming the government doesn't collapse and default on its debt, that is considered a risk-free return. You know exactly what percentage you're going to get paid every year. You can sleep peacefully.
But when you buy a stock, there are no guarantees. The company could go bankrupt. A new competitor could destroy their business model. The stock could lose half its value in 6 months.
So as a rational person, you are not going to take on that massive amount of risk unless you are compensated for it.
You demand an extra return on top of what the safe bond pays. That extra demanded return is the equity risk premium. It is the buffer you require to justify taking a leap of faith into the stock market.
The NYU Stern paper gives us a staggering historical baseline for this. They looked at data stretching all the way back from 1928 to 2021. Over that nearly century-long period, the S&P 500 generated an average annual return of 11.82%.
Okay, and over that exact same time frame, what did the safe government bonds do?
The 10-year Treasury bond averaged a 5.11% return, and the super short-term 3-month Treasury bill averaged 3.33%.
So if we just do the basic math there, historically, investors have looked at the stock market and said, I need to make about 6.7% more than a 10-year bond pays, otherwise I'm not playing the game.
Yes. That 6.7% spread is the historical equity risk premium. But here is the critical part. The ERP is not a static number engraved in stone. It is a live, breathing indicator. It acts almost like a global thermostat for human fear.
Here's where it gets really interesting. The Damodaran paper gives us a microscopic, real-time look at how this fear thermostat behaves during a crisis. Let's rewind to the fall of 2008.
The collapse of Lehman Brothers.
Paint a picture for me of what the ERP looked like right before the collapse versus during the free fall.
Picture this. It's mid-September 2008. There are rumblings in the housing market, but the broader stock market is still relatively calm. The S&P 500 is sitting around 1250.
Okay.
At that exact moment, the implied equity risk premium was 4.20%. Investors were relatively comfortable. They only demanded a 4.2% premium to hold stocks.
But then, on September 15, Lehman Brothers files for bankruptcy, the largest bankruptcy in U.S. history.
Total panic ensues on Wall Street. The credit markets freeze. Nobody knows which bank is going to fail next. Between September 12 and October 10th, a span of less than a month, the S&P 500 plummeted from 1250 down to 903.
That's a catastrophic drop in a matter of weeks. So what happened to the fear thermostat? What happened to the ERP?
As stock prices collapsed, the implied equity risk premium skyrocketed. It shot up from 4.20% to 6.39% almost overnight.
Stop right there and explain what that actually means in human terms.
Yep.
A jump from 4.2 to 6.3 doesn't sound like a lot to a layperson.
Think of it as the price of admission to a burning building. In mid-September, investors were willing to hold stocks for a moderate expected reward. By mid-October, the building felt like it was on fire.
Right.
Investors collectively screamed, I am not holding these volatile assets unless you mathematically guarantee me an enormous, massive premium.
And because the market couldn't instantly manufacture higher corporate earnings, the only way the math could offer that higher premium was for the stock prices themselves to fall drastically.
The price drops until the expected future return meets the new, panicked demands of the investors.
That is fascinating. Now, the math behind calculating that expected future return relies heavily on cash flows. How much actual cash are companies returning to their shareholders?
Historically, that cash flow primarily meant dividends. A company makes a profit and mails a check to its shareholders every quarter. But the Damodaran paper highlights a massive structural shift in how modern finance works. Today's stock buybacks have overtaken traditional dividends as the primary method of returning cash.
A buyback is when a company uses its own cash to buy its own shares off the open market and retires them. It reduces the total number of shares, which makes every remaining share inherently more valuable.
Exactly. But this shift led to a wild anomaly that Damodaran points out. Let's look at the 12 months leading into January 2016. The companies comprising the S&P 500 collectively returned 101.54% of their earnings to shareholders through a combination of dividends and incredibly aggressive stock buybacks.
Wait, hold on. Let me see if I've got this straight. They returned 101% of their earnings. They gave back more money than they actually made in profit. How is that even mathematically possible?
It's possible because of debt. Remember earlier we talked about low interest rates?
Yeah.
Because borrowing money was so cheap, companies were literally taking out loans, issuing corporate bonds at tiny interest rates, and using that borrowed cash to buy back their own stock.
That sounds insane.
It is mathematically unsustainable in perpetuity.
Yeah.
You cannot forever borrow more money than you earn just to artificially inflate your stock price. This forces financial analysts to constantly tweak their models.
Because when calculating the true equity risk premium, they can't just use that 101% figure. They have to adjust it down to find a sustainable payout ratio. Otherwise, the models break.
Exactly.
Let's tie this entire ERP concept back to you, the listener, navigating the market right now in 2026. Earlier, we noted the U.S. Bank data showing the 10-year Treasury is sitting around 4.0% to 4.25%.
Right.
Because that risk-free rate is lower than it was during the peak inflation scares of a few years ago, the entire mathematical equation shifts, right?
Precisely. A lower risk-free rate generally means the discount rate applied to future corporate earnings is lower. In simple terms, it makes a dollar earned by a corporation 10 years from now look more valuable today.
And this fundamental math pushes current stock prices up.
Yes, but investors are still out there constantly adjusting their fear thermostat. The premium they demand today fluctuates every single day based on their confidence in that sturdy 2.6% GDP growth we talked about, weighed against any lingering fears of geopolitical shocks or inflation returning.
But I want to take a step back and look at the architect of that risk-free rate. How did the central bank get so much power over the stock market in the first place?
Good question.
If you look at financial history, the Federal Reserve didn't always dominate the daily stock market conversation the way it does now.
To understand that massive shift, we have to transition to the Loyola University Commons paper on quantitative easing. We have to go back to the crucible of 2008 one more time.
The Great Recession really changed everything.
It really did. Before 2008, the Federal Reserve's traditional weapon to fight a recession was very straightforward. They lowered the short-term federal funds rate. If the economy slows down, make borrowing cheaper so businesses can expand.
But during the 2008 crisis, the economy was in such a horrific freefall that the Fed rapidly slashed that rate to essentially zero. They hit what economists call the zero lower bound.
Because you can't really lower interest rates below zero. You can't charge people to keep their money in a savings account without causing a riot. So the Fed was out of conventional ammunition. But the building was still burning.
They needed a new unconventional weapon. So under Chairman Ben Bernanke, they introduced quantitative easing, or QE. They ultimately initiated 3 massive, unprecedented rounds of it over several years.
I want to break this down because quantitative easing sounds like a phrase designed in a lab to make people fall asleep. In plain English, what is QE?
Well, how does the Fed printing money to buy government bonds actually help my stock portfolio go up?
Bernanke theorized this would work through something called the portfolio balance channel. Let me give you an analogy. Imagine the financial market is a massive sponge holding water. The water represents investment capital. The Fed steps in as a massive buyer and purchases trillions of dollars worth of safe assets, specifically 10-year Treasury notes and mortgage-backed securities.
And by aggressively buying all those safe bonds, 2 things happen. First, they inject massive amounts of liquidity, new money into the banking system.
Second, because they are buying up all the supply of those safe bonds, the price of those bonds goes up. And in bond math, when the price goes up, the yield, the interest rate it pays out, goes down.
So the Fed essentially crushes the return on safe investments on purpose.
Exactly. They squeeze the sponge. When the yield on safe government bonds drops to rock bottom, large institutional investors, like pension funds that need to make a 7% return to pay out retirees, look at a 1% Treasury bond and say, I can't survive on this.
The Fed has essentially forced them out of the safe haven of bonds and pushed them into riskier assets, like the stock market.
It's forced migration of capital. The Fed drives down safe yields to shove money into equities, which drives up stock prices. And the theory is that higher stock prices create a wealth effect for consumers, making them feel richer, which encourages them to spend money and stimulate the actual real-world economy.
That was the theory. But the researchers at Loyola University didn't just take Bernanke's word for it. They wanted to test it mathematically. They utilized a machine learning algorithm, specifically a C5.0 decision tree, to predict the direction of the S&P 500.
Break down a decision tree for me. How does this algorithm actually work?
Think of a decision tree like playing a massive game of 20 questions with the stock market. The algorithm takes a huge data set of historical variables: interest rates, oil prices, inflation, unemployment, And it repeatedly asks yes or no questions to split the data into groups.
It's looking for which specific variable most accurately predicts the final outcome. In this case, the target outcome was, will the S&P 500 go up or down next week?
So it's trying to find the ultimate predictor.
Yes. The researchers looked at the data from before the 2008 crash, and then they ran the algorithm again on the data from after the crash, when quantitative easing was actively running.
And what were the results?
The results revealed a total paradigm shift in how the financial world operates. Before the 2008 crash, the decision tree found that the single most important variable in predicting the stock market's movement was the 10-year Treasury note. That makes perfect sense based on everything we've discussed about traditional finance and the equity risk premium.
Right. The traditional risk-free rate steered the ship, but what about after 2008?
After the crash, the algorithm showed that the 10-year Treasury note lost its predictive dominance entirely. The new absolute dominant predictor of the stock market's direction became the size of Fed assets, which means the size of the Federal Reserve's balance sheet.
Think about the philosophical implication of that for a second. The actual amount of money the Fed was printing and injecting into the system via QE became a more reliable indicator of the stock market than traditional interest rates or corporate earnings.
Yes. Central bank intervention permanently rewired the dependencies of the market. You literally could not analyze the market post-2008 without looking directly at how much money the Fed was pumping into the system.
It proves mathematically that the invisible hand of the free market, as envisioned by classical economists, had essentially been replaced, or at least heavily augmented, by the very visible, very powerful hand of the Federal Reserve.
So if the market isn't entirely a free market anymore, if it's this complex beast driven by GDP projections, deep human psychological biases, fluctuating equity risk premiums, and massive central bank liquidity injections, how do human analysts actually figure out what individual stocks to buy? Are they just guessing?
Not at all. They have structured methodologies. We reference the DeLuca Guide to break down the human toolkit. Traditionally, human analysts divide themselves into two very distinct, almost philosophical schools of thought: fundamental analysis and technical analysis.
Let's start with fundamental analysis. This is the classic Warren Buffett approach to investing, right? Finding intrinsic value.
Exactly. Fundamental analysts treat a stock ticket as a literal piece of ownership in a physical business. They don't care about the squiggly lines on a stock chart. They are digging into the income statements, auditing the balance sheets, and scrutinizing the cash flow statements.
They're calculating metrics like the PE ratios we discussed, assessing return on equity, and analyzing debt levels.
It's like looking under the hood of a car before you buy it. You want to see if the engine is actually well built. They look at the macroeconomic context, like that 2.8% global growth Goldman projected, and they try to find a durable, high-quality business that the market is currently underpricing.
The strength of fundamental analysis is undeniable. It anchors you to reality. It anchors you to the big picture. It helps you identify durable consumer staples or robust healthcare companies that have the actual cash reserves to survive a recession.
But there's a glaring weakness, isn't there? The market...
That is exactly the weakness. Market sentiment, the deep fear and extreme greed we saw in behavioral finance, can shift stock prices wildly before the fundamental accounting ever catches up.
You might do all the math correctly. You might find an incredibly undervalued company.
But the market might just ignore it or actively trade against it for years. You might be mathematically right, but still lose money because the crowd disagrees with you.
Which opens the door for the second school of thought: technical analysis. These are the chartists.
Right. Technical analysts approach the market completely differently. In extreme cases, they don't even care what product the company actually makes. They care about price action.
They are looking at visual charts, tracking price trends, plotting moving averages, and identifying historical psychological levels of support and resistance.
So if fundamental analysis is looking under the hood of the car, technical analysis is ignoring the car entirely and just looking at the traffic patterns on the highway to decide when to merge.
That's a great way to put it. Technicals provide timing. They tell you the momentum of the crowd right now. But technical analysis has a massive, sometimes fatal blind spot. It can fail spectacularly when it encounters a wallop.
Because the chart can't predict a completely unprecedented global event.
Exactly. The DeLuca Guide gives the quintessential modern example. March 2020, the sudden onset of the COVID-19 pandemic. Right before the crash, technical analysts saw that the Dow Jones was sitting comfortably above its 200-day moving average.
In the world of technical analysis, sitting above that long-term average is considered a very strong indicator of safety
and an ongoing bull trend.
The chart said, everything is fine, keep buying.
But then the pandemic became a reality. Panic selling ensued. And that supposedly unbreakable technical support level wasn't just breached, it was obliterated in a matter of days. Technical analysis completely collapsed in the face of a fundamental, real-world wallop.
So if fundamentals can trap you in a value trap for years and technicals can get you wiped out by a wallop, what are the best human analysts actually doing?
The DeLupa Guide suggests the most successful human analysts don't pick a side. They use a hybrid approach. They merge the two disciplines.
How does that work in practice?
They let the fundamental analysis dictate what to buy. They do the hard math to create a curated watch list of strong, durable, undervalued companies.
But they don't buy them right away.
No, they let the technical analysis dictate when to buy. They watch the charts of those fundamentally sound companies, waiting for the right dip in price or a clear momentum shift to actually execute the trade.
It's the best of both worlds. It prevents you from chasing an overheated garbage company just because the chart looks exciting, and it helps you avoid catching a falling knife, buying into a fundamentally sound company at the exact wrong time while the market is still aggressively punishing it.
It requires immense discipline. To execute this perfectly, an ideal trader would need to instantly read and comprehend every corporate balance sheet on Earth, monitor every shifting macroeconomic trend globally, memorize the exact real-time price charts of 500 different companies simultaneously, and somehow completely strip away all human emotion, fear, and fatigue.
Which is impossible for a human brain.
Which is exactly why the machines have entered the chat.
I have been waiting for this part of the deep dive. This brings us to our final and undeniably most futuristic source, the 2026 ArcSive paper detailing a hybrid AI-driven trading system.
We are stepping out of theory and into science fiction that has become financial reality.
The researchers who published this paper built an artificial intelligence that essentially automates that ideal hybrid human approach we just described. But it processes information at a scale, depth, and speed that is literally incomprehensible to a human analyst. Let's pop the hood on this AI. Let's meticulously unpack the architecture of how this thing actually makes decisions. I want ELI 5s. Explain it like I'm 5 for all of this, because the paper gets heavy. It operates using 4 integrated modules.
Module 1 is technical analysis.
Yeah.
The AI is constantly absorbing and calculating a variety of technical indicators for every stock it watches. It looks at the 50-day and 200-day exponential moving averages.
What's the difference between a simple average and an exponential one?
An exponential average gives more mathematical weight to the most recent days, so it reacts faster to sudden price changes than a simple average would. It also tracks the MCD, which is a momentum gauge that shows the relationship between two moving averages, signaling if a trend is accelerating or exhausting itself.
Okay, what else is it looking at?
It uses the RSI, the Relative Strength Index. Think of the RSI like a rubber band attached to the stock price. If the stock shoots up too fast, the RSI hits overbought territory, suggesting the rubber band is stretched too far and might snap back.
If it drops too fast, it hits oversold, suggesting a bounce might happen.
And finally, it monitors Bollinger Bands.
Explain Bollinger Bands.
Imagine the stock's price chart is a winding highway. The Bollinger Bands are the outer lanes and the shoulders of that highway. They measure volatility. If a stock's price suddenly crashes into the lower band, it's essentially driving on the rumble strips. It tells the system, warning, extreme volatility here. This asset has deviated wildly from its average.
So the AI is looking at all of these technical charts simultaneously. What does it do with that data?
It feeds all of those technical indicators into the second module, a machine learning model, specifically an XGBoost classifier.
XGBoost. That sounds like an energy drink. What is that in computer science terms?
Without getting bogged down in the code, XGBoost stands for extreme gradient boosting. Imagine you have 100 different decision trees like the one we discussed in the Loyola QE study, and they're all looking at the data and trying to predict tomorrow's stock price.
Okay, a forest of decision trees.
Exactly. XGBoost is an algorithm that links them all together. It looks at where the first tree made a mistake, and it builds a second tree specifically designed to fix the first tree's error, then a third tree to fix the second's error.
It sequentially learns from its own mistakes at lightning speed until it produces a highly accurate binary prediction. Based on these technicals, will this specific stock return a positive or negative result tomorrow?
That is incredibly powerful. But what happens if the overall market is crashing? You don't want to buy a single good stock if the whole market is collapsing around it.
Which is why it has a third module, the Market Regime Detection Filter. The AI calculates a 20-day simple moving average of the overall broader market returns. It only allows the system to place trades during favorable bullish regimes.
If that macro environment moving average trends down, signaling a bear regime, the AI actively suppresses trades. It just sits in cash to avoid systemic downturns.
But the fourth module is the one that completely blew my mind. This is the absolute game changer, the sentiment analysis module, powered by Finbert.
This is where we cross into new territory. Finbert is a domain-specific natural language processing model. It's built on the transformer architecture, similar to ChatGPT, but it was trained almost exclusively on financial text earnings reports, analyst notes, and financial news.
So it knows how to read Wall Street jargon.
Fluently. Here is how it operates. Every single morning, before the U.S. market even opens at 9:30 a.m. Eastern Time, Finbert scours the internet. It reads the financial news headlines, articles, and summaries for the 100 S&P 500 stocks currently in its training pool.
Think about the scale of that. While a human analyst is just waking up, pouring their first cup of coffee, and maybe scanning the front page of the Wall Street Journal or Bloomberg, Finbert has already ingested, read, and comprehensively analyzed the global news cycle for 100 major corporations.
It doesn't just read them, it scores them. It assigns a mathematical sentiment score to every stock, ranging from positive 1.0 down to negative 1.0.
And the researchers discovered a brilliant way to use the score. They don't use it to find stocks to buy, they use it as a shield.
Exactly. It's a pure risk management tool. The researchers established a strict threshold. If the Finbert sentiment score for a stock drops below negative 0.7 serial count Z, meaning the news that morning is overwhelmingly negative, perhaps indicating an unexpected massive earnings miss, a sudden CEO resignation, or a new federal regulatory investigation, the AI instantly halts all trades for that stock.
It completely bypasses human emotion. This is the cure for the behavioral biases we talked about earlier. A human analyst might see a horrific headline for Apple and think, it's Apple, I've loved this stock for 10 years, they always bounce back, eventually I'll hold on to it.
The human brings ego into the trade.
The AI has no ego. It sees a negative 0.71 sentiment score and coldly, instantly cuts the position to protect the portfolio from a negative news shock.
And the researchers put this entire four-module system to the test. They ran a rigorous backtest, simulating live trades on those 100 S&P 500 stocks over a very volatile 2-year period, from January 2023 through January 2025.
And that time frame is important because it wasn't just a straight lineup. That period included significant bullish runs, aggressive interest rate tightening by the Fed, and unexpected geopolitical shocks. It was a messy market.
So they ran the simulation, and the results are, well, they are staggering, absolutely crushing. Over that 2-year period, the baseline traditional momentum strategy they compared it against delivered a total return of 8.64%. The S&P 500 index itself, just buying and holding, returned 53.18%.
And the hybrid AI system?
The hybrid system delivered a total return of 135.49%.
135% over 2 years.
That translates to a compound annual growth rate, or CGR, of 53.46% per year.
Okay, but any system can achieve massive returns if it takes wild, reckless risks. If I put all my money on black at the roulette table, I'll get a 100% return in 10 seconds, but it's an awful strategy. Did this AI just take massive gambles?
That is the most impressive part. It didn't. To prove that, the researchers calculated the Sharpe ratio.
What is a Sharpe ratio? Explain that for us.
The Sharpe ratio is the ultimate measure of risk-adjusted return. Think of 2 drivers trying to get from New York to Boston in 4 hours. Driver A weaves through traffic at 100 miles per hour, narrowly avoiding 3 crashes. Driver B takes a smooth, clear back road at a steady 65 miles per hour.
They both arrive at the exact same time. They achieve the exact same return. But driver A took on significantly more risk to get there. The Sharpe ratio measures how smooth the ride was.
Okay, so a higher Sharpe ratio means a smoother ride with less volatility.
Right. In the financial world, a Sharpe ratio over 1.0 is considered very good. A ratio over 1.5 is considered exceptional. The hybrid AI system achieved a Sharpe ratio of 1.68.
Wow, so it crushed the S&P 500 while arguably taking on less chaotic risk.
The downside protection proves it. The system limited its maximum drawdown, which is the absolute biggest peak-to-trough drop the portfolio experienced during the simulation, to just negative 15.6%. By comparison, the baseline strategy suffered nearly a 20% drawdown.
How did it achieve that? How did it generate 135% returns while keeping the maximum loss to only 15%?
It achieved that capital efficiency through a risk parity approach, using a final metric called the average true range, or ATR.
What does the ATR do?
The ATR measures the pure volatility of a specific asset. A human trader might say, I'm going to put exactly $10,000 into every stock I buy. That's equal dollar weighting. But the AI doesn't do that. It adjusts its position sizes dynamically based on the ATR.
If a stock is currently behaving wildly, swinging up and down 5% a day, a high ATR, the AI buys fewer shares of it. If a stock is very stable and predictable, a low ATR, the AI buys more shares of it.
It's mathematically balancing the risk so that no single volatile stock can blow up the entire portfolio.
Exactly. This dynamic position sizing ensures the portfolio's overall risk is evenly distributed, allowing it to adapt to bullish, bearish, and highly volatile regimes flawlessly.
It is breathtaking to think about. The researchers ran this entire architecture on a cloud-native platform using Amazon Web Services, plugging the AI directly into a live brokerage API. It is the culmination of every single thing we have talked about today, executing decisions in milliseconds without a single drop of human hesitation.
If we pull back and connect all of these dots for you, look at the incredible journey we've taken through the mechanics of this market. We didn't just look at today's closing bell.
We started with the macro view. Goldman Sachs projecting a 2026 GDP outperformance, and the Federal Reserve actively pulling the levers of interest rates to steer the massive ship of the U.S. economy.
We explored the historical realities of the equity risk premium, the fundamental foundational math of why we demand a reward for putting our capital at risk in the first place, and how that demand spikes violently into a 6.39% premium when human fear takes over, like it did during the Lehman collapse.
We waded into the theoretical debate between the efficient market hypothesis, which assumes we are all rational actors perfectly pricing $111 trillion worth of assets, and the very real behavioral biases, the momentum chasing and the herd mentality that cause irrational market bubbles.
And we saw how central banks, via quantitative easing, literally rewired the predictive inputs of the market, making the Fed's balance sheet more important than traditional treasury yields.
And finally, we saw all of that human knowledge, all of those fundamental intrinsic value theories and complex technical charting methods synthesized into cloud-based artificial intelligence systems. Systems like Finbert that read global news sentiment in milliseconds to protect against wallops, while an XGBoost classifier trades the S&P 500 with cold machine learning precision.
The ultimate takeaway for you, whether you're just a casual observer trying to make sense of your retirement 401k statement, or an active investor trying to navigate the complexities of the 2026 landscape, is that no single metric tells the whole story.
You cannot just look at a spreadsheet of interest rates and predict the future. You cannot just look at a stock chart and ignore the macroeconomic weather.
You have to see the whole board. Understanding these intersecting layers, the massive macroeconomic drivers, the deep-seated, somewhat flawed human psychology, and the new algorithmic logic of the machines. That is the ultimate shortcut to being truly well-informed in today's market.
Which brings us to a final thought I want to leave you with today. We spent quite a bit of time discussing the efficient market hypothesis, which has been the dream of classical economists for nearly a century. The idea that all public information is instantly and perfectly priced into the market.
We know that humans, heavily burdened with our fear, our greed, and our heuristics, fail to create that perfect efficiency. But now we have AI systems absorbing global news sentiment in milliseconds, running infinite decision trees, and executing risk-parity trades at the speed of light, entirely devoid of emotion.
It's a completely new paradigm.
So the question you have to ask yourself is this. Are these AI systems finally creating the perfectly efficient market that economists have dreamed of, where everything is instantly and correctly priced? Or, as thousands of these incredibly fast, hyper-intelligent algorithms begin to battle each other on the servers of Wall Street, reacting to news and to each other in milliseconds, are we just creating entirely new, completely unpredictable, and potentially far more dangerous market cycles that no human could ever possibly foresee? Something for you to mull over.